When you hear the phrase financial bailout, you're probably thinking of 2008, right? But what if I told you the blueprint, the actual playbook for every modern bank rescue was drawn up over a century ago? We're talking the age of gas lamps and horse-drawn carriages. Okay, let's dive into the pretty wild origin story of Too Big to Fail.
So, what does a modern bank rescue have in common with a panic in Victorian London? It's a fantastic question, right? And the answer is almost everything. Seriously. The secret meetings, the frantic backroom deals, that terrifying feeling when everyone realizes that one company failing could crash the entire global economy. It all happened before. And the way they handled it back in 1890, well, that created the playbook we're still using today.
So before we jump in our time machine, let's make sure we're all on the same page with this key term, too big to fail. Now, this isn't just about a company being huge. It's about it being so woven into the fabric of the economy, so interconnected that if you pull on that one thread, the whole thing just unravels. Keep that definition in your back pocket because it's the entire reason this story even happens.
All right, let's set the scene. The year is 1890. The place is London, and at this time, London was the undisputed center of the global financial universe. Think of it as the Wall Street of its day, but on steroids. And right at the heart of that system stood a titan, our main character, Baring Bank.
You know, to say Baring was a big deal is a massive understatement. This was not your local bank on the corner. This was a dynasty, a global powerhouse that financed wars and propped up nations. Honestly, their reputation was seen as being as solid as the Bank of England itself. They were, for all intents and purposes, untouchable. And well, maybe that feeling made them think they could take a gamble on a scale that nobody else would even dare. Or so they thought.
And here's where things get interesting, and where it all starts to unravel. Baring made this enormous, all-in bet on a developing economy halfway across the world, Argentina. For a few years, it looked like absolute genius. Money was just pouring in. But then, in 1890, a little political instability led to a coup, and the whole Argentina economic bubble just burst. I mean, spectacularly. And it left Baring on the hook for millions, with absolutely no way to pay it back.
So suddenly, the problem wasn't just about Baring's bad investments anymore. No, the entire global financial system, which had trusted Barings completely, was now staring right into the abyss. And this is where that idea of contagion becomes terrifyingly real.
This quote from the time, wow, it just perfectly captures the mood in London. Baring Bank was that single spark. If it went down, it wasn't just going to be a little fire. The real fear was that it would ignite a chain reaction and burn down the entire forest of the global economy. Panic was starting to set in.
So what would have actually happened if they just let that first domino fall? Well, the chain reaction would have been catastrophic. We're not exaggerating here. We're talking about a complete freeze in global credit, dozens, maybe hundreds of smaller banks getting wiped out, international trade just grinding to a halt, all of it pointing to a near-certain worldwide depression. The stakes just could not have been any higher.
So, facing this economic apocalypse, the governor of the Bank of England, a guy named William Litterdale, knew he had to do something completely unprecedented. He had to basically invent a solution on the fly. And this is key, he had to do it in total secret to stop a mass panic.
And what they came up with is the blueprint you see right here. And this plan, it should feel eerily familiar. First, Litterdale does the unthinkable. He gets all of Baring's biggest rivals and locks them in a room. Then he pulls off the impossible. He convinces them to use their own money to create a massive rescue fund for their competitor. And the final, critical piece of the puzzle? They did the whole thing in absolute secrecy, making sure the public had no clue what was happening until the deal was already done.
And just like that, it was done. Without a rulebook, without any precedent, the world's financial leaders had improvised the very first too big to fail bailout. They'd saved the system from itself. But in the process, they'd created an incredibly powerful and controversial new tool.
And this slide just brilliantly shows how little the core idea has changed in all that time. I mean, look at the parallels. It's led by a central bank. The goal is always to prevent systemic collapse. The main action is to guarantee risky assets. The biggest difference, of course, is that shift from a group of private banks funding the rescue to rescues that now involve public taxpayer money. The tech has changed, the numbers have gotten way bigger, but the ghost of the Baring rescue, it absolutely lives on.
Which brings us to the big question, the one that has haunted finance ever since that crazy week back in 1890. Is this blueprint a necessary tool for keeping the system stable? Or does knowing that a safety net exists just encourage big banks to take even bigger risks because, hey, they know they might be considered too big to fail? The legacy of the Barings crisis is that even now, we still don't have a clear answer.